Picture this. You're up late scrolling through tickers and you stumble across a tiny AI microcap trading at just $1.80, a company most people overlook, even in the bustling tech AI microcap space. It's the kind of play that doesn't make headlines. But quietly, it could be setting up for 3 to 5 times upside in healthcare workflow AI. And suddenly, you wonder, what if the real opportunity isn't in flashy AI demos, but in solving practical, everyday problems that professionals actually face? This is the story we're exploring today, a company that doesn't glimmer in headlines, but grinds in real customer workflows. By the end of this video, you'll understand why this $1.80 AI isn't just a price. It's a story of real product, real traction, and real potential upside. Here's the question: what if the next asymmetric tech payoff doesn't come from hype, but from utility that's just now getting traction? That's the theme we're unpacking, and we're going to do it through one specific company, a NASDAQ-listed small cap, trading under $2, but with real product, real customers, and real momentum. Stick with me, because by the end, you'll see the opportunity and the risks in stark clarity. This isn't about dabbling in price action. It's about understanding structural purpose in a business. Successful investors don't chase chart patterns. They chase value that expands over time. Think back. Cloud computing was once unloved infrastructure until it became essential. Storage solutions, server farms, enterprise workflows, deemed boring until they weren't. The early investors who saw through the noise captured huge upside. Here's a mantra you should carry forward: bet on meaningful utility before the market fully appreciates it. In today's landscape, AI isn't just about dazzling demos. It lives in the tools professionals use every day. And that's where today's company positions itself, deep in workflow optimization for the care economy, an area long dominated by massive platforms like Epic Systems, yet still full of friction at the frontline level. All right, let's reveal the name. Amesite Incorporated, ticker AMST. Trading around $1.80 per share, this is absolutely a microcap tech play. But micro doesn't have to mean meaningless. Amesite builds AI-powered platforms, including Nurse Magic and other enterprise workflow solutions, meant to help healthcare providers streamline documentation, communication, and compliance. This isn't simple automation. It's task efficiency, reducing processes nurses once spent 20 minutes on. That's real utility inside a approximately $330 billion addressable healthcare segment. But let's talk about the hard numbers, because that's where credibility is earned or lost. Over the trailing 12 months, revenue sits near $193,000, up approximately 69% year over year. A tiny base, but growing. Net losses persist, around $3.3 million, meaning the company is not profitable yet. That's typical for early-stage software players, but it's worth noting, this isn't a profitable story yet. Amesite holds roughly $1.83 million in cash, no debt, and a strong current ratio, suggesting it has runway for ongoing execution. Shares outstanding are about 4.57 million, with a market cap hanging under $10 million. Extremely small by tech standards. For perspective, the price to sales multiple cites north of 30 times trailing sales, steep relative to traditional software valuations, but not unusual for companies at this stage of scale. Now let's put that into context. If revenue continues expanding and reaches even modest enterprise levels, that multiple contracts rapidly. And the story isn't theoretical growth. Amesite reported sequential quarterly revenue expansion of approximately 69%, with customers increasingly engaging with its AI platform. What's driving this? Real adoption across healthcare and care provision scenarios, from independent agencies to post-acute care verticals, the same environments where large vendors like Oracle Health often struggle with speed and customization. But let's acknowledge the elephant in the room. With such a small base of revenue, every dollar matters. If adoption stalls or larger contracts don't materialize, valuation could languish. That's why execution, not just concept, matters with this kind of tech microcap. Another risk, balance sheet strength. Amesite recently faced scrutiny around NASDAQ equity requirements. A reminder that sub-$25 million equity levels invite ongoing compliance focus. And because the business remains unprofitable, ongoing financing or equity raises are entirely possible. Dilutive risk for shareholders. But there's a counterpoint here. The company is de-risking costs while still expanding revenue. A rare signal in early AI plays. This suggests disciplined spending, not reckless burn, while still achieving traction. Now let's frame possible outcomes. Conservative, sub $1.20. If growth stalls or financing pressures intensify, base $3, $5 range. If revenue scales steadily with enterprise customer adoption, bullish. $6 plus, if the platform gains broader enterprise footprints and predictable recurring contracts. None of those are guaranteed, but they frame a risk-reward spectrum. Speaking of risk, let's unpack the key ones. First, cash flow risk. Operating losses persist and free cash flow is negative, meaning continued financing may be needed. Second, scale risk. With a small customer revenue base today, any contraction in spending by clients could disproportionately impact results. Third, execution risk. This is still early-stage software. Sales cycles in enterprise healthcare can be lengthy and require persistence. But on the flip side, the product is solving sticky routine problems that larger incumbents often overlook. If Nurse Magic and its related offerings become essential in daily clinical workflows, recurring revenue and contract extensions could follow. And that's where the value equation changes. From tiny revenue base to predictable enterprise revenue streams. Think about the macro trends here: aging populations, labor shortages in care sectors, and AI adoption accelerating everywhere. If healthcare professionals adopt tools that reduce paperwork and improve care quality, that's not a fad. That's structural necessity. This story isn't about hype, it's about utility that can be monetized repeatedly. But remember, utility alone doesn't guarantee valuation expansion. Execution, sales scale, customer retention, and financial discipline do. Now, here's the question for you. Do you think AI tools that improve real-world workflows are underpriced by the market today, or is this still too early to bank on operational traction? Drop your thoughts in the comments. And keep this nuanced. This is analysis, not a buy/sell signal. So before you go, here's your takeaway. Amesite Incorporated is not your typical penny technology story. It has actual product adoption, it has real revenue growth trends, and it's tackling tangible inefficiencies in healthcare workflows. But it's also very small, currently unprofitable, and execution risks are real. The market prices it today as a high-risk, high-optionality microcap. If adoption accelerates and revenue scales into recurring enterprise contracts, the narrative changes. If not, it remains a speculative story. If you want more deep dives like this, real numbers, balanced perspective, and context that matters, hit subscribe and tap that bell so you don't miss the next analysis. Next video, we're unpacking another under-the-radar tech opportunity, but with a completely different risk profile and growth theme. Stay analytical. Stay inquisitive. And remember, the best investors don't chase noise. They understand where real impact meets real financial signals.